Hey traders, welcome to the Global Macro Update, where we run through all of the news that matters for the week, the economic events that are coming, and the charts that are of importance to us this week. So let's get into it. Getting started with the news that matters this week, starting with China as usual. Obviously, China's still big on our radar and potentially driving what we saw in the dollar this week and kind of across the markets. I know a lot of people were saying it was the Fed rate hikes that were pushing markets lower, but those were really expected in the markets. And what we saw this week was some really disparaging news coming out of China that may be pushing these markets lower, maybe pushing the dollar higher as the risk off kind of folds out of the Chinese markets into the global markets. So firstly, what we saw was the Chinese stocks entering an official bear market, having dropped 20% from their peaks in February. And all of that with kind of the backdrop of Beijing trying to calm the nerves of investors. We have not only that, but 15 mutual funds committing to buy equity products kind of between the range of 80 to 100 million yuan, which is around $15 million. So not a huge amount of money, but these mutual funds are committing to buy equities, which you can just see when you have participants in the market committing to buy equities. There's something going on underneath that. They're trying to prop up the market as they did back in 1929 in the US markets, probably trying to kind of come to peace with the Chinese government, showing the Chinese government they are being active in trying to prop up the market so they don't get too much backlash. And what we're seeing is a continued fall in those markets. When we look at the chart, as we can see, we are expecting even further falls. We're sitting at kind of 46, 41 now at the CSI 300 index. Our downside targets are sitting around about 3,300 for the CSI index. So we don't see this kind of move in the markets abating. We continue to see a bear market heading throughout 2022, probably into early parts of 2023 as well. So this bear market's definitely just getting its legs to the downside now and should continue to run throughout the year, which leaves a lot of stress, a lot of impact on Beijing to kind of step in, and also just showing you exactly what we're seeing in the property market, how that property market is kind of, that property market turmoil is unfolding into the rest of the Chinese economy. So that's just been interesting to watch. Speaking of the Chinese property crisis, Evergrande looking to be dismantled, reported by Bloomberg. China weighs breaking up Evergrande to contain the property crisis. Basically, the proposal calls for Evergrande to sell most of its property assets, and it's going to be keeping the electric vehicle asset for whatever reason. We're just showing you how initially Evergrande was looking to restructure. That restructuring was said to be one of the most complex restructurings in the history of debt markets, in the history of companies. And we see that Evergrande is now struggling with that, and they're looking to move on and basically just break up. They're getting a lot of pressure from Chinese government, Chinese officials to just dismantle Evergrande by selling the bulk of the assets, and then the bad debt manager Cinder Asset Management would take over any of the unsold property assets. But we know that these asset management companies like Cinder are under a lot of pressure. They're also sitting with huge amounts of debt. So basically all they're doing is taking bad debt off the balance sheet of these major companies so that these major companies still have room to invest in their properties. But it's all basically financial engineering. It's not driven by any economic growth. It's not driven by any demand for the property market, because that is now rolled over, as we mentioned last week. So it's all of this financial kind of magic spoofing that they're trying to do to defend the financial markets and defend the property market and prevent the contagion of this issue into the financial market as a whole, which they're failing to do, as we continue to see headlines rolling out regarding the property market. We saw the Jizhou city in central China's Henan province take back 12 plots of land from China Evergrande Group without compensation. So the Chinese government's already starting to kind of confiscate land from these over indebted property developers. So Evergrande, basically all their projects are coming to a halt, and now because of their debt issues, the local governments are taking back that land, just showing you that these property developers are really under pressure now. Included in that is a property developer, Hobson Development Holdings, who basically lost their auditor this week. PricewaterhouseCoopers decided to resign from as the company's auditor, and what they mentioned was that it did not receive any information on certain matters and could not plan and complete the necessary audit procedures. These matters included accounting treatment of certain of the group's equity investments and property projects, and the valuation of properties, which is obviously a big one. So Hobson Group obviously not willing to disclose the value of their properties because of how much pressure they're under, and how much they've probably declined when it comes to mark-to-market, which puts them probably at levels that at least show that they are in financial problems, but more than likely showing that they are probably bankrupt. And the stock plunged 27% on the news. And just a reminder that Hobson Group was in talks with Evergrande to buy into Evergrande stock, to take over Evergrande stock, at least half of the shares issued by Evergrande back in October, but those talks fell through. And the reason they fell through is because Hobson was just under as much pressure as Evergrande, and as much debt as Evergrande. And this isn't a small company either. They're about $40 billion market cap at the moment, obviously down big from their highs in June, July 2021. So you can just see from this chart how they are under massive pressure, and in a pretty much 60%, more than 60% bear market in their stock. So we're just seeing contagion across the board in property stocks in China, and that goes well beyond that. And speaking of that, we see this week Bloomberg reporting that Chinese cities are basically selling land to themselves. Bloomberg reporting property crisis means Chinese cities sell land to themselves. And what this means is that you have these local government finance vehicles who have become the biggest buyers of property. So basically, the local government funding vehicles have avoided property sell-off sparked by Evergrande by buying back property from themselves and propping up the property markets in their local regions. So what we saw was a recent land auction by the Chinese city of Rizal, which looked normal, but what we saw were bids pushing up the price of the land 11% to $170 million, and a closer look revealed that these offers were reportedly made by a finance entity owned by the city itself, meaning that the city effectively sold land to itself. So across China, local government financing vehicles have replaced cash-strapped property developers as the biggest buyers of land for real estate development, stoking fresh concerns over the ability of these off-balance sheet borrowers to repay a debt pile that tops at least $8.4 trillion. So we're just seeing continuation of these symptoms that the Chinese financial markets are under serious pressure. They're doing increasingly bizarre things to try and prop up their markets. And once they run out of these bizarre things to do, we're going to see these markets really roll over strongly. And we just know that even as a whole, we have Beijing pushing these governments to push for this common prosperity drive, this really socialist drive to expand public services in education, healthcare, housing. But a lot of that cost burden is being pushed onto these governments, which are already under serious pressure because the financial crisis or the property crisis is unwinding. So we're just seeing increased pressure on these local governments to do these bizarre things, to keep the main government in Beijing happy while trying to pretend basically that they are not being affected by the property crisis. And it's just kind of unfolding and snowballing as time rolls on. And we just know that these governments are under serious debt, under serious pressure. And it's just a matter of time until they break. And not only that, when we look at China as a whole, the industrial profits grew at the slowest pace in 18 months in December. That was reported by Yuan Talks. Industrial companies saw profits grow at their slowest pace in more than a year and a half in December, indicating softening demand amid rising pressure on economic recovery, adding to expectations of more supportive measures. So again, we're seeing Chinese government cutting rates. We're seeing property markets under pressure. We're seeing industrial profits dropping. We're seeing the CSI 30, the Chinese stock market, entering into an official bear market territory. And we just continue to see this Chinese financial crisis unfold and basically snowball, and we'll continue to see not just Chinese commodities, but commodities in general roll over. And as we keep saying, once we see oil roll over, which we believe is imminent, probably around about April, we'll see oil roll over. Oil's generally the last thing to move. But once oil rolls over, we'll see how this is actually not just a Chinese issue, but it really is part of a more global problem and a global financial crisis that is on the horizon, basically sparked by what we saw in the Fed continuing to withdraw liquidity from the markets this week. So heading over to US news. Starting with US news, we have rate hikes will ruin China. Basically, we're showing you how systemic the issues are in the global economy at the moment as the Fed starts to reduce liquidity in global markets. China already warning that that is going to really hurt its exports, as reported by Bloomberg, which is obviously going to impact their economy in a massive way. China relies massively on exports for their markets. As we mentioned last week, imports are already under pressure as a result of a tightening of conditions in the consumer market in China. So if exports start to get hit as well, we're just going to see that kind of unfold into the Chinese economy. And again, just seeing all the weak points that China's economy has at the moment, the property market, the financial markets, the equity markets, and now import-export markets. That's why we're seeing commodities rolling over, why we're seeing such pressure on global commodities. And it's a big effect of the Chinese snowballing issues that they're having as a result of a collapse in their property market. This week, we had the Federal Reserve meeting. They pointed towards interest rates coming in March, as reported by CNBC. And basically, their policy meeting indicated that it was likely to raise rates in March, which is basically expected by the markets, which is interesting to see, as we said, why the dollar was rallying this week, because it was expected to see those March rate hikes by the Fed. It also reaffirmed plans to end its pandemic-era bond purchases that month, or in March, before launching a significant reduction in its asset holdings. So we're looking at quantitative tightening, we're looking at Fed funds rate increasing, and basically the Fed funds futures market pricing as many as 5 US rate hikes this year, with some analysts forecasting 6. We had Goldman Sachs predicting 5 times this year. We had Bank of America predicting, I think it was 6. So we're just seeing how these markets are really pricing in these rate hikes. But we have a global economy that is just so weakened that 6 rate hikes by the Fed is actually going to lead to a global recession and just, again, cause massive problems for the global financial situation, especially in China. And not just China, we're talking about the emerging market as a whole, because as that liquidity dries up, we have huge amounts of debt sitting on emerging market balance sheets. As we mentioned last week, that was kind of defended by the DIIS, the initiative that basically allowed for breaks in these debt repayments in emerging markets as a result of COVID, but that's drying up now. These developed markets want their money back from emerging markets, and as liquidity starts to tighten in emerging markets, it's going to cause massive issues for those guys to pay back those debts. It's going to push the dollar higher. It's going to push emerging markets into a debt crisis, and as we mentioned many, many times before, we're going to see a global recession as a result of that. And basically, that goes back to what we're saying in the last news that matters, that the Fed is basically trapped because we have a weaker US consumer already. US consumer spending is weaker. We have rising inflation. That's all posing a dilemma for the Fed because it's now basically hiking its rates into a weakening US economy, but not just a weakening US economy, it's a weakening global economy. And as we mentioned previously, we believe that inflation is going to roll over because you had all these retail inventories coming out month on month at record highs, and big record highs, sitting at actual 4.4%. We're expecting 1.5%. So that's a massive hit for inflation because these retailers are basically loading up on inventory to basically counteract or take advantage of the inflationary conditions. But they now have so much inventory on their hands that they're going to have to start to sell it for discount, which is going to push inflation lower, going to disinflation and probably eventually deflation moving forward. So that's happening in commodity markets as well. You have all the producers basically buying up as many commodities as they can as prices continue to rise, but now they don't have the demand that leads to the unraveling of these inventories or the offloading of these inventories. So they're going to have to start to sell at a discount, sell at a loss, and that's just pushing the narrative that we've been pushing for some time, that we're going back into deflationary conditions. And retail inventories month on month that came out this month are showing that exact picture rolling out. So very interesting to see. And it's kind of showing you why the markets rolled over in the US this week. I don't think it was just because of the Fed. I think what we're seeing is a whole lot of different factors, from China to retail inventories to commodity inventories, showing you that the position that the market had is actually wrong, and we are now starting to unravel that position back towards that disinflation, deflation environment. So Sunday we have China's PMIs coming out, which will be interesting to see what kind of effect the economic slowdown that we're expecting is going to be having on Chinese PMIs. Whether they're accurate or not is still under question, but it will be interesting to see if there's any clues that we'll be seeing that China's economy is under serious pressure. Monday, we have EU GDP figures coming out. We have Australian interest rate decision and US ISM manufacturing PMIs coming out on Tuesday. Wednesday, we have EU CPI or CPI inflation figures. Thursday, we have BOE and ECB interest rate decisions. We're going to see if they're going to kind of react to the Fed's interest rate increases or whether they're going to remain the same. Again, we have debt issues that are a problem for both of these nations, where raising interest rates are a serious problem for them because it just increases the amount required to pay back those debts. So it'll be interesting to see their interest rate policies moving forward. We also have the US Services PMI on Thursday, which will obviously give us an indication of what the US economy is doing at the moment, and the expectation of the economy moving forward. And then Friday, we have US non-farm payrolls coming out. Interesting to see those figures, but I'm more inclined to wait for next month's US non-farm payrolls as we see, because if we have crypto markets rolling over, we have the US equity markets rolling over, it might mean people are not able to run off those profits anymore, run off their investments anymore. They're going to have to start looking for work, and we might find that these payroll numbers start to climb and maybe be seen as a bullish case, but really in reality we're seeing an increasingly desperate US population go out and look for jobs that may not actually be there this time because the economy has slowed. So we're kind of sitting in this perfect storm. It's going to unravel over the next few months, and that might just be a sign as to why I believe oil is going to roll over in April. It's because we start to see the actual reality of the situation in relation to the narrative. So it's going to be interesting to watch, and that's our economic calendar this week. Let's take a look at the charts and see what charts are of interest this week. We'll continue to keep a close eye on the dollar. As we mentioned last week, we suspected the dollar was ready for a nice big rally, and that's exactly what we saw this week. DXY taking off to the upside, was up, I believe, kind of 1.4% on the week, which is a big move for currencies. So the dollar continues its rally from those lows. Just zooming out to the lower time frames, everyone was talking about the death of the dollar back in 2020. We were talking about a bottoming out in January 2021. That's exactly what we got. You can go and look at our market preview for the 2021 markets. Just go back to the dates. Was it launched in 14th of January 2021, if I'm not mistaken, where we said look out for bottom in the dollar, and that's exactly what we've seen. Since then, we've seen the dollar climb over 8% to its current levels and doesn't look to be slowing down in any way. That's exactly what we've been talking about. It's the dynamic of the emerging markets coming under serious pressure to pay back their debts, which is leading to a shortage of dollars around the world. And it's basically got to do with the euro dollar rather than just the domestic dollar, and that's what's causing this dollar to rally. We also mentioned last week, expect silver and precious metals to drop, and that's exactly what we had this week. We had silver dropping around about or peak to trough was 10%, sitting at around about 9.5% now. So it took a big hit in silver. And as we continue to say, we believe silver is going to drop through this floor at 21 and head straight through the floor at 11 and go sub 10 over the next few months. So watch for silver this week to maybe consolidate initially, but come off in a big way moving forward. Same with gold. We're bearish gold. Gold bugs coming out in a big manner this week, looking for gold to rally. There was a little bit of a rally in the last few weeks, which gave them some hope. But this week, those hopes were squandered as we saw gold drop off its highs, kind of 3.5% to current levels, drop 4% peak to trough. And we continue to see gold moving to the downside. We suspect gold's going to all the way down below 1700 before a little bit of a rally, which is going to catch those gold bugs off guard, because they're going to go buy into that, and then that rally is going to fade, and we're going to see gold head down to at least sub 1400. That's our prediction moving forward, and that's exactly what we've been seeing since our gold predictions back in 2020. So watch for gold to start to accelerate to the downside this week. And watch gold bugs to continue to say that this is a great buying opportunity when it's really not in reality. Gold is going to be a great buy at around about 1250, but right now that's not the case. And why we say that, let's go back to other financial crises that we had. Obviously, the most recent one was the global financial crisis of 08-09. Gold is supposed to rally into these financial crises, and what we saw in 08-09 was a 34-35% drop in gold before we saw a turnaround. That's exactly what we suspect is going to happen now. We're going to see a good 30% drop in gold down towards that kind of 1400 to 1250 region, which is in line with that 35% drop we saw back in the global financial crisis. And then gold becomes a great buy, because once you have that initial drop, then you have the rally in gold, and that's what we see moving forward. So just be patient with that. So we're watching the dollar and precious metals this week in a big way. Oil's still a concern. We're still watching that, but I suspect we're going to see a little bit more upside, probably touch on $100 oil moving forward. Eventually, it might just be a slow chop back up to $100. But as we mentioned, oil is usually the last thing to roll over, as we saw back in 08 to 2011, or it was more like 2011. We had the European debt crisis, but oil really only rolled over properly in 2014. Although there was a drop in 2012, which was a year later. So watch oil to be the last man standing in this commodity market, but the rest of the commodities continue to sell off. We look at copper, also a big down this week. As we've been mentioning, copper topped out, we believe, in May 2021. Had some pretty decent rallies since then, but these are all corrective rallies, and continue to make new lows moving forward. So watch copper to likely make a new low, if maybe this week, if not next week. And obviously the rest of the precious metals will continue to sell off moving forward. SPX, very difficult to read. More than likely we'll get a bounce here, but this rising wedge and fall was just kind of very indicative of the top of a market. So watch for a rally in these markets, but really what we're watching for here is a rally that basically fades and turns into a sideways chop, which will give us the indication that we're looking for, that we have seen the top in the US equity markets. It's also possible we just rally from here, because basically everyone that believes the market or global financial markets are going down will look to put their money in the safest place, and the safest place, quote unquote, right now is going to be US equities, and that could see a huge influx of foreign dollars coming into these markets, which could see the S&P and US equities as a whole rally to new highs. So that's just something to keep in mind. I'm not a huge fan of buying this. It's very, very risky. I'm more kind of in the dry powder camp, but if you do want to put some risk on, we'll just be kind of patiently waiting to see what develops here. When we go into lower time frames on the S&P, we have a structure that could resemble a continuation pattern moving forward, but it's too early days. We're just waiting to see what's going to develop here. But basically, if we get a move down to these lows once more, and then one last rally up, that actually becomes a very, very bearish structure, because we'll be looking at that as an ABC flat pattern structure, which indicates further downside is on the way. So we'll be keeping an eye on that as a possibility in these US equity markets. But yeah, very, very cautious here. And finally, just moving on to Bitcoin and the crypto space. Be very, very wary of this current rally. I believe this is going to fold and roll over, if not now, at around about 40,000, kind of lining up to be a little bit of a rising wedge type structure that's developed here, which might just break to the downside from this level, which would be interesting to see. as a whole, the markets still look pretty bearish to me. I'm still kind of worrying whether we're seeing this as just a regular flat pattern, which would see 30,000 as a great buy, or if we go to the weekly chart and use the log chart, we might just see this drop kind of sub 20 before it takes off to the upside. So either way, I'm pretty bearish. I'm waiting for signs that this is a good buy. Right now, this is not a good buy. This is just a kind of fool's rally that's going to suck people into the market and roll over once again, I believe. It's cool, guys. That's this week global macro update done and dusted. Obviously, we'll be keeping a close eye on what's happening in China. We'll be keeping a close eye on what the Fed has to say, what the US economy has to say, and if those two policies are going to diverge. And we will be keeping a close eye on commodity prices moving forward, because that's going to be a big indicator that we may have rolled over already, and that bear market is underway already. So lots going on in the markets at the moment, so keep a lookout. Members, we will see you in the members area tomorrow morning for our game plan for the week and what we'll be trading, and investor guidance, guys. There'll be some new updates into the stocks to buy this week, so keep an eye out on that. If you're not a member on either of those, you can take a closer look in the link below, where we will fill you in and just keep you updated as to what's happening in the global markets on a daily basis and where you want your money to be. So take a look at the link below. Cool, guys. Have a great week, and we will chat to you next week.